Welcome to yet another episode of the Mortgage Motivation Podcast, and I'm your guy, Gary. We are back at it again. So today we will discuss something that's very important as it relates to any type of financing. All right, we call it the 4Cs. The 4Cs is something that a lender looks at anytime they're looking to evaluate you as a borrower. It doesn't really matter if it's a car, a credit card, any type of personal loan. We kind of follow the same rules. Now they can vary just a little bit, but we call these the 4Cs. And to me, if you want to get pre-approved for any type of loan, you want to stand by the 4Cs. This right here will help you get qualified. No doubt about that. So if you know these 4Cs, we should be good to go. All right. So the 4Cs are capacity, credit, collateral, and capital. Now we're going to say that again: capacity, credit, collateral, and capital. All right, so let's start off with something that's probably really important, which is the capacity. Capacity could be your income, and that's going to be a huge driving force as it pertains to you being able to purchase your home. And that's, of course, if you're doing a purchase or refinance, we will look at your income. The income is something that kind of drives the loan. Okay, we know how much money that you make a year, how much money you make a month. We want to break that down because the lender itself, they want to see how much money you have that's available for this loan. Can you repay back the loan, better known as the ability to repay? So we definitely going to look at the income. Not only the income, we're going to look at to see how long you've been working for that job, or how long you've owned your company, so we can see how long you've been making that type of income. And the income actually breaks down into a salary, that could be an hourly wage, or commission. So every type of payment or the way you get paid makes a difference to the lender, because they want to see what is the risk factor. The risk factor, you're going to hear a lot from any type of lender or loan officer, because that's what sets the tone of the mortgage itself. Is what is the risk factor? The higher the risk, the likelihood of you getting approved for a higher amount is going to be slim to none, or even approved at all. The lower the risk, the more options that you will have. So that is basically the capacity. Okay, how much money do you make a month? How much money do you make a year? How long have you worked that job? But they also want to see how often do you skip around. If you are going from one job to another, they want to just evaluate that for you, just to ensure that they're making the proper evaluation on your loan. So that would be the capacity. The second thing would be credit. Credit is extremely important, just as much as the capacity, because the credit itself shows past history and current history. So how well have you paid back your loans in the past, and how well are you paying back your loans in the present? Okay, that is extremely important. They're also going to look at the full credit report, not only just your credit scores, but the full credit report. The report itself shows what type of credit do you have? How often do you pay on time? Do you have any type of diversity in credit? And what I mean by that is, do you have like in installment loans? Do you have in a revolving credit? They want to see how well you pay back all your different types of loans, because if you just pay back an installment loan but have no type of revolving credit history, it's kind of hard to make a determination there. So they want to see a mixture of different credit that you're paying back at the time. What type of debt are you paying back? They can also see the age of your credit. So it makes a difference if it's someone that's just started paying credit back, or start paying debt back in the last year, versus someone that's been paying on debt for the past 20 to 30 years. So that's a great way for them to make a determination of what type of loan they can lend to you, what your interest rate is going to be based upon your credit history. So it goes way beyond just your credit scores. They want to look at the credit scores, of course, but they want to see your credit history. All right. So how well do you pay back your debt that you're taking out? All right. And coming in third place is going to be your collateral. What type of collateral are we looking at? They got to make a true evaluation of the collateral. Collateral could be, say you're looking to refinance a home, the collateral will be your home that you're looking to refinance. So if you owned a home already and you're looking to refinance that property, they want to make sure that your home has the true value that's needed in order for them to extend that loan to you. The second example would be if you're looking to purchase a home. So if you're looking to buy a house that's $500,000, the lender want to ensure that the house is actually worth $500,000. So what they're going to do is order an appraisal. The appraiser's job is to go out there and look at the true value of that property, the current value, because say that house was evaluated maybe a year or two ago for $500,000, doesn't mean that house is actually still worth $500,000. So the lender, before they extend that loan out to you, they want to make sure the value is there, because they're going to use that loan and use your collateral as a backup plan. So worst case scenario, because you have to look at let me put it this way. The lender always looks at worst case scenarios just in case you default on your loan. So if you own a home and you have a loan on that property, say you go through a foreclosure, right? If the lender have to put the house back on the market, they want to ensure that they could get the money back as much as possible. So before they give you that money, the value must be there. So like I said, we will order an appraisal just to ensure the value is there. All right. So there's a little bit more that goes into the appraisal itself, but for this scenario right here, we're just looking at the value, which plays a part of them extending the loan out to you. So the fourth and the final thing would be capital. Capital plays a huge role, just like the other three. Capital shows that you have money for the purchase of this home. That could be money that you have in your savings account, money that you have in your checking account. That could be a 401k, stocks, bonds. They want to see what type of money do you have that's liquid. You need money for your down payment. They want to see where it's coming from. You need money for your closing costs. They want to see your money is coming from. And beyond that, after you close on your loan, if you're buying your primary home, secondary home, and investment property, sometimes the lender have requirements beyond your settlement date. So say you're looking to buy a primary home, they want to make sure that you have enough reserves just in case, say something happens with your job or your income is no longer coming in. How long can you make a payment on that mortgage before you need income again? So that's going to make a difference if that's a year. I mean, not a year, but if that's, can be a year. But if that's a month, if that's 6 months from now, if that's a year from now, if that's 2 years that you could go on making payments to the mortgage because you have access to liquid assets. So you could take the money out of your checking account, your savings account, your 401k. You have the means of paying that money back. And what's going to happen is the more money you can show of assets or capital, the lower the risk is going to be for the lender. Once again, they're going to give you a lot of money so you could purchase that house. They're going to give you a lot of money so you can refinance your home. They want to ensure, worst case scenario, that the risk is a lot lower by lending this money to someone that have reserves or that has capital. So once again, they want to see where the money is coming from when you're making your down payment or you're making your closing cost payment. And also beyond settlement, how much money do you have access to once you close? All right. So those are the 4 C's. I hope that was pretty easy for you. And I try not to get too detailed because I know that could be a little confusing sometimes, but those are the 4 C's. That's what we pay attention to anytime we're looking to extend out a loan. So let's go in order again. So capacity, credit, collateral, and capital. If you're looking to get pre-approved, if you understand how those four items work, it's going to work out better in your behalf. All right. You got to understand how that works out for you. And also you can see the person that's lending you the money. Why are they looking at your loan the way they're looking at your loan? So the more you understand underwriting, the better off you're going to be when you're looking to purchase or refinance your home. So hopefully that gives you some insight of what the lender is looking at, aka the underwriter is looking at whenever they're making an evaluation of your home. Make sure you got your 4 C's in order and you won't have any problems buying a car, getting a mortgage, getting a personal loan, whatever the loan is. The better you have this lined up, that better off you're going to be. All right. Until next time, I'll see you. Peace.